In this video, we are going to talk about Peter Lynch's investing advices. So before starting this video, please like this video and subscribe to this channel for our future updates. The Fidelity Magellan Fund, NASDAQMUTFUND, FMAGX, was one of the most well-known and profitable mutual funds in the 1980s, and it was led by Peter Lynch, who is considered one of the greatest investors of all time. Mr. Lynch, how good was he? From 1977 to 1990, the Magellan Fund's net asset value increased by an average of nearly 29% per year, nearly twice the pace of the S&P 500 index fund. It's rare for an investor to make a 29% gain in a single year, and it's even rarer to do so over many years. Mr. Lynch, fortunately, hasn't kept his investment ideas to himself. He is the author of many well-regarded books that are widely regarded as classics. Beating the Street, Getting a Leg Up on Wall Street, and Learn to Earn, the last one co-authored with John Rothschild. If you read one or more of those books, you're likely to become a smarter, more savvy investor, but you could start with Lynch's 9 lessons, which are listed below. Number 1. In the stock market, the most important organ is the stomach. It's not the brain. The stock market's recent volatility has clearly shown what Peter Lynch was saying in this statement. Those that don't expect or can't manage volatility should look for other ways to create wealth, but there are few places where you can build wealth as efficiently over time as stocks. Lynch went on to say, "Every day, you must look in the mirror and tell, what am I going to do if the stock market drops 10%? What do I do if it drops by 20%? Is it true that I'm going to sell? Will I be able to leave?" If you answered yes, you should consider selling some of your stocks right now. If market declines have you selling out in a panic, or market spikes have you greedily buying up overvalued shares? Emotions can be a real performance killer. The most successful investors will do the exact opposite. It's better to be greedy when others are scared, and afraid when others are greedy, as Warren Buffett once said. Number 2. Buy what you understand. It's also important to invest only in stocks that you understand, because some firms are much easier to comprehend than others. It's not enough to know that a certain company manufactures cancer-fighting drugs, for example. You should know what drugs the company has on the market and how well they're doing, as well as what drugs are in its pipeline and how close they are to going to market, noting that many drugs never clear clinical trials well enough to make it to market. You must also be aware of competitor drugs on the market and in development. Simpler businesses include those that produce and sell soda, candy, and shoes. Make an effort to learn everything you can about the businesses and markets in which you want to invest. If you're willing to invest in a business, you should be able to justify why in clear language that a 5th grader will understand, and fast enough that the 5th grader won't get bored, Lynch says. Number 3. Don't be intimidated. It's easy to be intimidated by stock investing. After all, there's some math involved. However, much of the math isn't that difficult. For example, the price-to-earnings (P/E) ratio is just that: the stock's current price divided by its annual earnings per share, EPS. The annual dividend, which is sometimes 4 quarters worth of payments, separated by the current stock price yields a dividend yield. Lynch also pointed out that everyone has the mental capacity to keep up with the stock market. You should do it if you made it through 5th grade math. Number 4. Do your research. Many people purchase stocks after reading a few paragraphs about them in a magazine or, even worse, after hearing a few words from a friend or acquaintance. To get the best results, go through a company's financial statements, looking for things like how much cash and debt it has, how fat its profit margins are, if its sales and profits are rising, and by how much, and other figures. Ideally, gather a large number of interesting company ideas and study them to see which ones remain truly promising to you. According to Peter Lynch, the player who turns over the most rocks is the winner of the game. That has always been my attitude. Never invest in any business until you've done your homework on its earnings potential, financial situation, competitive position, growth plans, and so on, he said. Number 5. Understand that there are gray areas. Investing in stocks is an art, not a science, Lynch has said, and people who have been taught to rigidly measure all are at a significant disadvantage. This is important because investing is more than just numbers and math. Take, for example, a well-known disaster tale. Despite the fact that the long-term capital management hedge fund was managed by Nobel laureates, it imploded in 1998 and had to be bailed out with several $billion. When many smart and talented people research the same business, they can fairly arrive at different estimates and viewpoints. Tesla is an excellent example, as it has both staunch supporters and detractors. Number 6. Look behind the obvious. This is just another piece of Peter Lynch gold. Many would-be gold miners lost money during the gold rush, but those who sold them picks, shovels, tents, and blue jeans, Levi Strauss, made a tidy profit. Today, you can invest in non-internet companies that profit indirectly from internet traffic. Package distribution is an obvious example, or turn and related gizmos manufacturers that keep the traffic going. It's quick to spot clearly profitable stock ideas, but several others have already done so, pushing up their share prices. However, several other businesses are also operating in the shadows, helping those companies. Apple, for example, has been enormously popular, but it isn't doing so on its own. It relies on a large number of suppliers for its hardware, including Universal Display. If you're optimistic about e-commerce, you could look into delivery companies like FedEx and UPS, as well as various retailers. Consider equipment manufacturers like Middleby if you're in the restaurant business. Number 7. Consider mutual funds. All of this will lead you to conclude that studying businesses is not something you can do now or in the future. You may not have the time, interest, or expertise to do it right now, or even to learn about it. That's fine, there's a viable alternative. Mutual funds are a form of investment vehicle. After all, it was a mutual fund, Magellan, that delivered that incredible 29% annual return. However, keep in mind that such a remarkable record is extremely rare and almost impossible to locate before it occurs. For most of us, low-cost broad market index funds, such as those focused on the S&P 500, are possibly the best option. Over long periods of time, they have outperformed most other equity mutual funds. Equity, stock, mutual funds are the best choice for people who want to buy stocks without doing their own research, says Peter Lynch. Number 8. Expect losses. When it comes to saving, it's also important to plan to lose money. They will happen regardless of whether you are a good or poor investor, and whether you invest in individual stocks, managed equity mutual funds, or index funds. Even Warren Buffett and Peter Lynch, who said, Warren Buffett has made some regrettable moves. If you're successful in this market, you'll be correct 6 out of 10 times. 9 times out of 10, you're never going to be right. Number 9. Be patient. Finally, be patient, for most great wealth in the stock market is created over decades, by both wealthy and well-known individuals such as Warren Buffett and Peter Lynch, as well as average people who have become wealthy by investing. As Peter Lynch previously stated, when you own shares in superior firms, time is on your side. Consider reading at least one of Peter Lynch's investing books. Most people can understand his writing, and his lessons can help you make a lot of money. Number 10. If you're lucky enough to have been rewarded in life to the degree that I have, there comes a point at which you have to decide whether to become a slave to your net worth by devoting the rest of your life to increasing it or to let what you've accumulated begin to serve you. At the height of his career, Peter Lynch left the mutual fund industry. Rather than chasing for more money, he used the wealth he had amassed to live a full life. Perhaps Lynch's most important lesson is this. What do you think about our video? Did any of above advice help you in investing? Let us know in the comments below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button and turn on notifications before you go. Thanks for watching.